Joining us now to discuss RBC Capital Markets retail analyst Brian Tunick, as well as SunTrust senior internet analyst Youssef Squali. Gentlemen, good morning to you both.
Morning.
Brian, I'm going to start with you. I'm going to ask you the same question I've been asking quite a number of our guests on the air the last couple of days. Is the story here still Amazon versus everybody else? Or when you see more collaboration, more retailers essentially breaking down and listing their stuff on Amazon's platform, is it much more nuanced?
Well, I think it definitely is more sleeping with the enemy the last couple of years. A lot of these brands have realized they can't go at it by themselves. But I think you have to look at what's happened here. You know, we've got about $6 billion worth of retail bankruptcies and store closings the last couple of years. So I think that has definitely helped put a better footing under the companies that have survived. Amazon has certainly upped the ante on shipping and delivery. So I think the margins of existing retailers will remain depressed, but I think surviving is no longer the big question. So I think we're actually in a better way, and obviously consumer spending, consumer confidence is strong.
Youssef, how key is the bread and butter e-commerce business of Amazon still to the company more broadly and to the stock and how investors are thinking about it, especially when you have the front page of the Wall Street Journal today talking about advertising. You have the AWS reInvent conference, which John Fort is at, underway right now.
It's still very important. It's key. It's that bridge that's going to get them to the next areas of growth, which we can discuss later. And that's advertising, as you said. That's AWS and a few other areas. Connected TV being another area. But today, the stock continues to trade first and foremost on its ability to grow faster than overall e-commerce and continue to therefore, claim a disproportionate amount. Our work would indicate that in this holiday season, Amazon will get about 50% market share of all gross merchandise volume and about a quarter, of about 24-25% of all revenues. And they already dominate. They already dominate the market. Yes, they're growing faster. But to Brian's point, I think the reason what Amazon is doing is really important is because it's really elevating everybody to a better game, and a game that ultimately is good for the consumer.
Brian, I mean, if that's the game, which among the traditional retailers that you cover are better and worse positioned? It seems like the market is kind of going after, mall stores that have just too many stores and they have to be in closure mode like the Gap. But where do you think the winners and losers set up?
Yeah, so again, companies that have gotten to 25% or better e-commerce penetration, it's been really painful on the margins, right? I mean, remember, the pie isn't growing big enough to support 25% e-commerce growth and obviously have flat store growth, right? The pie's not growing fast enough. We've seen $6 billion worth of retail bankruptcies and store closings, more to come, still watching Sears, JCPenney, Bon-Ton, Toys R Us, et cetera. So there is market share opportunities. But again, it is very painful on those delivery costs, right? The consumer wants it all. They want same-day delivery. They want to be able to return in the stores. I mean, 30% of everything bought online is returned. I mean, these are painful economics.
30%?
30%. It's even more than that, I think, if you look at shoes and other categories. So the logistics, the distribution centers, these are a lot of expenses, and companies that were levered up in the PE boom certainly didn't have the liquidity to make those changes. They're going bankrupt. Again, we've seen 25 companies go bankrupt. I think the crop today is in a much better footing. They have the balance sheets, and they've already done the store closings that I think we're going to already need to see.
Youssef, one narrative that's been spun is that the tax refunds coming up in the spring are going to make at least the first half of 19 look a whole lot better than the back half. Is that pretty much consensus now?
I believe so. I think that's something that we look at every year, and it's always a nice thing to have. But that, to me, is supplemental to the core kind of secular trend that's happening there. And that remains very much intact. In fact, if anything, the consumer this year has proven to be a lot stronger than we thought he or she was coming into the year. So the question is, with the economic slowdown in the second half or sometime next year and then in 2020, how will the consumer react? Net, we still think Amazon, from a an infrastructure play, from a logistics play, still has the best defense mechanism to weather even that kind of a storm.
Youssef, where do you stand on eBay? I mean, I know the company is looking to focus more on payments and advertising, build out its e-commerce, et cetera. But when you have more traditional retailers like Walmart and Target looking to grow their own e-commerce, can it still remain in that #2 position and then continue to grow from there?
Very hard. We have a hold rating on eBay. Unfortunately, they have not been able to reaccelerate that GMV growth that we've been expecting for the last 2 years. In fact, if anything, if you look at the last 2 or 3 quarters, GMV growth has slowed down in the face of increased marketing spend. So it's very hard for eBay to maintain its position. The other thing is, as you look forward 2, 3, 4, 5 years, eBay is still structurally challenged about being an omni-channel platform. Today, eBay is first and foremost an online platform, whereas Amazon has already moved on to becoming an omni-channel, and Walmart has gone from being a retailer to an omni-channel as well. eBay is kind of stuck in that, Internet 2.0, and it's really, really hard to get out of it.
Gentlemen, thank you for your thoughts today.